China.
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 If you're bullish on China, you cannot miss this video because we are hunting for the fastest growing company in China today. Hi guys, Stanley here. I'm the co-founder of ValueInvestAsia.com, an investment portal where we'll give you investment news and in-depth analysis on listed companies every single week. So if you're new to this channel, remember to hit that subscribe button so you will not miss out on any of our videos and news. When it comes to China, investors tend to be very opinionated in this market. Either you are very optimistic about China or you might not want anything to do with it. But the truth is always somewhere in the middle. Like all markets, there are some great companies in China and there are some pretty terrible ones. Yet, we cannot deny that it is one of the fastest growing, large-scale market in the world. So if you're able to find a growing company to invest in China, it might have the ability to grow for decades without ever reaching its saturation point. So today, we are setting out to find some of the fastest growing company in China with the help of our sponsor, Share Investor Web Pro. Share Investor Web Pro is one of the best value for money data providers for investors right now. The web-based software means that I can do my research almost anywhere, and I can easily look up to 10 years of financial data of any company at a glance, and even compare a few companies together. The best thing is they provide data for stocks across multiple markets, including Singapore, Malaysia, Hong Kong, US, Australia, and even markets in Indonesia and also Thailand. This is especially useful for investors like myself who like to invest in both Asian and also Western markets. One of the most powerful tools it has is its screening tool. It helps us narrow down our search for the right company just within seconds. So if you're looking for a financial data provider, you can check out Share Investor Web Pro. You can find out more on our link below, and when you're ready to sign up, remember to use our promo code to get a $20 off your subscription. Okay, now let's look deeper into what exactly is a screening tool. It is basically a software that allows us to kickstart our investment search in the simplest possible way. There are thousands of stocks in the stock market and it can be very confusing on where should we start our hunt. A screen allows us to filter out the companies that meet our financial criteria so that we do not need to read through every single stock in the stock market. Let's use Hong Kong Exchange as an example here. Due to the China-US tension, many Chinese companies listed in the US have moved their listing to Hong Kong. And the City Exchange is still a far more desirable destination for new Chinese companies to get listed instead of its mainland exchanges. So Hong Kong Exchange is a great place for investors to start looking for high-quality, high-growth companies from China. Now let's jump into Share Investor Web Pro, and this is how I set up my screening criteria. I like to follow the advice of Einstein here, where everything should be as simple as possible, but no simpler. Basically, we should just have a few criteria first to narrow down our search instead of using tons of criteria and finding the perfect stock right away. This is because screening is just the beginning of our search, and we want to remove companies that do not show consistent growth or have very bad balance sheet. From there, then we should investigate further on which company might be worth our time and investment. I put down just 5 criteria for my growth screen template. The first one is the compounding annual growth rate of our revenue. And I like to set it at around 10% a year growth for the past 5 years. Why we put in the CAGR for growth in revenue is basically I want it to show me that the company have products or services that are growing in demand and customers are buying more and more of them. This helps us show that the company has a real need in the market and is serving the right market. The next one I want to screen out is also the CAGR for net income, and I prefer it to be at the simple same rate at 10% a year for the past 5 years. To screen for CAGR in net profit is to show me that the company can indeed extract profit out of its product and services and not just growing revenue for the sake of growing bigger in size. So this is very important. Next one, I will also track the CAGR for earnings per share. Again, I'll just track it at the same rate at 10% a year for the past 5 years. We track earnings per share growth to ensure that the company does not experience huge dilution risk for the investors. This is because some company, they are able to grow both revenue and net profit very consistently over the past few years, but they grow that by continuously raising more and more equity, and that dilutes the shareholder. So we want to put in this criteria to screen out those companies that have huge dilution risk. The next one I want to screen is return on equity. We've done a video on return on equity specifically and why this is Warren Buffett's favorite ratio. So this ratio basically tells us if the company has very good capital allocation skill and if the management is able to reinvest their money into the business at a good return. I like to put this at about 10% a year as well for over the past 5 years. So this means that for every dollar that the company reinvests in the business, I prefer it to show additional 10% return on the business as well. The last criteria is to track the debt level of the company, interest coverage. Interest coverage is basically how much the profit of the company can cover its interest costs. So if a company is using too much debt, its interest coverage will be very low because its profit might not be sufficient to cover its interest costs. So to track and make sure that the company has a good balance sheet, I prefer it has an interest coverage of more than 8 times, say consistently over the past 5 years. So all we have to do is to set this up on Share Investor and I can screen for it for the Hong Kong market. Alright, and now we have the results that we are able to screen out about 33 companies on the Hong Kong Exchange that meet our criteria. That cut down our search significantly from all the 2,000 stocks in Hong Kong Exchange to just this 33. From here, we can look deeper into the company that might interest us. The first thing that typically I like to do is just rearrange them maybe according to their growth rate, or we can rearrange them according to their equity. Let's, for this example, look at the CAGR return on earnings per share, and maybe I like to find the one that is growing the fastest because I'm looking for a growth stock. So here we can look at the description of the business first to see if it's a business that I understand and I'm optimistic about. For example, this China Feihe is in the production of infant formula milk and other dairy products, and you can see that the company has been around for quite some time, and this is quite interesting. Then I might feel that, oh, this company is interesting and I want to find out more about on why it is growing so well, and let's look deeper into the financials of the company. Okay, firstly, I like to check if the company is a large enough company that it has a stable business. We can see that its market cap is around 150 billion Hong Kong dollars in this case, which is quite sizable, and it tells me that the company is quite established in the market. So when looking through the financial, I'm looking through a few things in more detail to ensure that the company is of good quality. Firstly, I want to look at how the revenue has been growing. Is it lumpy or has it been quite consistent? So we can see that the company really took off in 2017 and it has grown very, very well since then. It might have struggled a little bit in the beginning of the years, but so far it has been able to show quite consistent growth. And next I want to look at also its net profit growth. So let's look at its net profit growth over here. And you can see that it really took off in 2017 as well. And I'll just do a quick calculation on its profit margin. I like to look at profit margin to ensure that the company has a pricing power in the market. So in this case, China Feihe has about a 40% net profit margin, which is extremely impressive. But I might want to investigate a little further why an infant milk formula company can have such an amazing profit margin. I can do that by reading through its annual report and maybe checking on its financial notes as well from the annual report to see if it's making the profit margin quite consistently, and the profit margin is really established from the business itself. We can also scan through its free cash flow trend, and from here we can see that the company is consistently producing good cash flow from the business and reinvesting them, the red colors, reinvesting them into the business as well. And the last thing I prefer to check out is the net debt to equity and also its interest coverage, just to see if the company has a good balance sheet. And we can see that its interest coverage is actually increasing over the years with a very low net debt to equity. That's a good sign that the company has a good balance sheet and should be able to weather through any crisis. So this is a company that definitely has intrigued me, and what I'll do next is to add it into my short list of stocks. So I'm going to create a list and I'm going to add in all these interesting stocks that I find, and I might review them and analyze them even further in the future. So next we should also go back and check out other stocks that might interest us and add them into our short list as well. So here we have the next company, Greenland Holdings, and I can see that it's a property development company. Typically, I try to stay away from property development companies as the revenue and profit can be very lumpy due to the cyclical business, and it's very, very hard for us to predict confidently on the growth to see if it's whether it is a sustainable growing company. To keep things simple, I'll just avoid looking into property companies in this example. Okay, on next, we can see a few more property companies like China Ouyuan, China Overseas Property as well. So many properties companies are growing very fast. If property sector is something that you find interesting, maybe you can look through this company as well. But this next company might be of interest to me for my investment style, which is Sunny Optical, and I can see that it is a company that is making optical and optical devices. So this company is in the hardware tech sector, and that's something that is of interest to me. So what I'll do again is to click into the company and let's look through its financial. So the company has been growing very, very well over the past few years, and you can see that its revenue has grown more than 10 times over the past decade. Similarly for its profit as well. Here is its profit. And next we'll look at its profit margin. Looking at its profit margin from the latest year, it has a profit margin of more than 10%, which is pretty decent. And I like it to be that way so that it shows me that the company has some pricing power in the market. And we can check out its cash flow as well. The company is reinvesting very heavily over the past few years and might run into negative cash flow, but at least the company shows some net positive operating cash flow consistently. So I know that the business is generating cash to reinvest for itself. And lastly, let's look at its interest coverage. You can see that the interest coverage of the company is slowly declining, meaning that the company is taking on a little bit more debt compared to China Feihe, but is still at a reasonable level at about 20 plus. Therefore, against this company, Sunny Optical, definitely very interesting for me, and I'd like to add it into my short list as well. So this is how you can see that I have set up my investment process. Basically, after the screen, I'll look through every company to ensure that it is a business that I like, and also that the growth in revenue and net profit is consistent from its financial and is showing a very good profit margin as well on the business. You can see that one of my favorite stock, Tencent, is also within this list. We have done quite a number of videos on Tencent on why this is such an impressive company. So do definitely check out some of our videos on Tencent, but specifically. There you have it. You can see that from this simple exercise, we have found 3 very promising companies that might be interesting to invest in within a short few minutes. What I do next is maybe to download all their annual reports and read through them over the past few years. It will give you a sense of the business and how it has been performing year on year from the management viewpoint. Apart from that, I like to check if the management has been consistent. So look at some of the targets that the management has set for themselves a few years ago, then check back in recent report to see that if they're still talking about those targets, or maybe they just forgot about it after they failed to meet them. This shows us how serious management is about growing on their business. Next, just do a simple search on Google or YouTube and other financial blogs to get views from other investors on what they think of the company. And with all that work that you put in, you might just gain a very complete picture of that company. And after all that, and if you're still optimistic and want to invest in the company, you can also check out Share Investor Web Pro consensus estimate on their target prices. So it gives you an idea on how analysts around the industry are valuing that stock in particular. So that's it for our video. If you want to screen more stocks for your investment, remember to check out Share Investor Web Pro and sign up with our promo code to save that $20 for your subscription. If you want to learn more about investment processes and the financial criteria that I set up for this screen, you can check out our free investing course at valueinvestasia.com/free course. We'll go through with you step by step on how to analyze a company from start to finish. As always, till we meet again, my name is Stanley. Invest safely.